You're listening to Financial Market Insights for Traders, where we break down the real strategies, mindsets, and tools serious traders need to grow and succeed, especially in the prop trading world. I'm your host, Sophia, and today's episode is all about one word: consistency. Whether you're in a prop trading evaluation or already managing a funded account, consistency isn't just a buzzword. It's what separates long-term profitability from short-lived luck. And if you're trading without a clear, disciplined plan, that inconsistency will cost you. That's why today we're focusing on how to build a prop trading plan you can actually stick to. Let's get into it. Why a trading plan is non-negotiable for prop traders. Here's the truth. Most traders don't fail because of bad strategies. They fail because they don't stick to any one strategy at all. They jump from system to system. They overtrade when they're emotional. They ignore risk limits. And in the world of prop trading, where you're trading with someone else's capital under strict rules, that lack of consistency can kill your account faster than any losing streak. Prop firms are not looking for the next market genius. They're looking for risk-managed, repeatable results. That's where your trading plan comes in. A trading plan removes emotion. It gives you structure. And more importantly, it gives you something to measure and refine. So let's break down exactly what needs to go into your plan and how to make sure you follow it. 1. Define your trading strategy. The first piece of the puzzle is your strategy. And no, I trade whatever looks good on the chart is not a strategy. You need to define your approach with total clarity. Ask yourself, what market are you trading? Forex, crypto, indices, futures? What time frame fits your lifestyle and edge? Are you scalping, day trading, or swing trading? What indicators or tools are you using? Moving averages, RSI, Fibonacci levels, support/resistance zones. What exactly are your entry and exit rules? What type of market condition are you targeting? Trending, ranging, or high volatility setups? Everything should be rule-based. If you can't write it down clearly enough for someone else to follow, it's not a strategy, it's a guess. Then, take your strategy and backtest it. Go through historical charts and ask, how would this strategy have performed over the past year? Then move to forward testing in a demo environment to simulate live execution. That's how you build confidence without risking real capital. 2. Lock in your risk management rules. This is the backbone of your trading plan. Even the best strategy can fail if the risk side is ignored. Here's what you need to define. Risk per trade. Stick to a percentage. 1% to 2% of your account is the sweet spot for most prop firms. Max daily drawdown. If your firm limits you to a 5% daily loss, set your personal limit below that to stay safe. Risk to reward ratio. Aim for at least 1 to 2. Winning 50% of your trades at 2:1 puts you solidly in profit. Stop loss and take profit placement. Base them on ATR, structure levels, or volatility, not emotion. Position sizing. Use a calculator, not your gut. Adjust lot sizes based on trade risk and account balance. And always remember, your number one job is capital preservation. If you lose the account, you lose the opportunity. 3. Trade criteria and execution. Next, let's talk about execution. You need a clear pre-trade checklist. Before you click buy or sell, ask, does this setup meet all my strategy criteria? Am I within my risk limits? Is the market condition favorable for my setup? Is this trade based on analysis or emotion? Also, decide in advance how you'll manage the trade. Will you scale in? Move stop loss to break even after a certain move? Take partials at key levels? The more you plan ahead, the less room you leave for emotional decisions. That's how you stay consistent. 4. Set personal trading rules. Now we move beyond charts into discipline. These rules are about controlling you, not just your trades. Here are a few rules worth including. Trading hours. Only trade during optimal liquidity hours. Overtrading late in the day or during dead zones leads to bad decisions. Take breaks. After 3 consecutive wins or losses, step away. This avoids overconfidence and revenge trading. Keep a journal. Log every trade with screenshots and notes. Journaling gives you insight into your habits, mistakes, and patterns. Weekly reviews. Set time each weekend to review your trades and performance metrics. Avoid trading when emotional, FOMO, anger, boredom. Walk away. You're not just managing trades, you're managing yourself. 5. Track your performance, adjust responsibly. Tracking your results is critical. And not just your PL. You need to know your win rate, average or multiple per trade, average drawdown, best and worst performing setups. This data helps you spot what's working and what needs refining. But here's the key. Don't overhaul your strategy after one losing week. Adjust with intention, not panic. Only change your plan when the data proves it's necessary, and only after testing the new changes in a demo. 6. Build psychological resilience. This is where most traders fall apart, the mental game. The markets will test your patience, confidence, and discipline. Your mindset needs to be part of your trading plan. Accept losses. They are part of the game, not a sign that your strategy is broken. Practice patience. If your setup doesn't appear today, don't force trades. Trust your process. If you've done the testing, stick to your edge. Practice mindfulness, breathing, meditation, exercise, whatever helps you stay grounded. Discipline beats dopamine every time. Sticking to the plan. So, how do you actually stick to the plan? Here are 4 key practices. Set consequences for breaking your rules. Pause trading, reduce size, or journal the mistake immediately. Use accountability. Join a community or work with a mentor who checks your progress. Backtest and forward test. The more confident you are in your strategy, the easier it is to follow. Treat it like a business. You're not gambling. You're managing a portfolio under risk controls. Behave like a professional. Why prop firms value consistency? Let me be clear. Prop firms don't want gamblers. They want consistency. They'd rather fund a trader who earns 5% a month with low drawdowns than one who makes 30% one month and blows up the next. Your job is to show them you can stick to a process, that you can manage risk, that you can handle pressure. That's what gets you funded and keeps you funded. Final thoughts. A trading plan is not just a document, it's a blueprint for accountability. It's how you train your discipline, protect your capital, and show the prop firm you're someone they can trust with their money. If you're ready to put your plan to the test and trade real capital with a structured risk framework, check out crystalballmarkets.com. They offer broker-backed prop trading programs designed for traders who are serious about consistency and growth. Until next time, trade smart, stay disciplined, and remember, consistency is king. This is Sophia, and you've been listening to Financial Market Insights for Traders. See you in the next episode.